why the FOMC is almost irrelevant. In this video, I'm going to break down why the FOMC meeting, why their decisions should not affect your long-term investing and trading process. So remember, this is according to my research. I do have a free newsletter. Link to that will be in the description. In the moment, the FOMC meeting, it can feel huge, right? We just came off the back of a huge meeting from Kevin Walsh. It felt, massive in the time. And I feel like these meetings typically do when markets are maybe a bit bearish or, it's like a sideways summer chop. There needs to be an excuse almost to kind of get excited and, get all, worked up about something. So rate decisions, they affect borrowing costs, valuations, and economic conditions. So on the day, it can feel massive, and there's going to be volatility in both ways. So typically, if you are going to invest off the back of this meeting and so on, it has to be a scalping decision. So it's important, but very difficult to build a long-term strategy around it. So saying, the Fed are going to cut in 6 months' time, it's quite difficult to predict that. And yeah, there'll be ways, but I think for most people, it's probably best off to take what they say on board and take, okay, cool, nice one. But look, individual meetings within a cycle rarely change the long-term picture. These things are typically priced in before the meeting. So markets typically price all of this in weeks or months in advance. So before any meeting, you can see exactly what probability the market is, assigned to a hike, a cut or a hold. There's ways to look online, like what the predictions, like what people are looking at. You can probably go on prediction markets as well nowadays to get a clearer view. So the meeting confirms what the market has already decided. 2-year Treasury yield is the most reliable leading indicator. So the 2-year Treasury yield almost always moves before the Fed does. Now this might change with Kevin Walsh. We had Jerome Powell for a while, so people will sort of get used to what he's doing. Kevin Walsh might be a different animal. He could be throwing in random rate cuts, and obviously it's not his decision, it's the committee's decision, but things could be slightly different. So by the time it is in a headline or so on, or you see it in the news, the move's already happened. It's something I talk about a lot on this channel, that if you're reacting to the news, if you're reacting to something, these things are typically priced in. Markets, they look into the future, essentially. And you've got to think that when it comes to headlines. Headlines are a lagging indicator, markets are a leading indicator. So buy the rumor, sell the news, happens a lot in the FOMC. Like, this is bullish, he's cutting, blah, 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 sells off. And it might just be a sell off in the near term to go, carry on higher. But I think the moral of the story is to not react to, what they're saying and what they're talking about. So zoom out on any asset and it barely registers anything. If you look at the S&P on a monthly chart, you can't tell what the Fed are doing. It doesn't say written on the candlesticks that the Fed have cut here, the Fed have hiked here, whatever. BTC on the yearly chart, it doesn't tell that. It doesn't tell what the Fed are doing. Gold, the same. So the trend is always important. When you zoom out, you can't see what the Fed's doing, and it doesn't matter. And I feel like when it comes to longer term stuff, trying to plan what the Fed are going to do in the future in like a 6-12 month out is pretty difficult to do. So the counterpoint, zero rates mattered during COVID. So this kind of goes against everything. When the Fed announced 0% interest rates during COVID, you could have made the prediction then like, risk assets are going to soar. So this is kind of like a counter to the argument where it does really matter in some cases. So, and then in 2022, they obviously hiked massively, which, coincided with a huge sell-off. So there is instances where it does matter, but your typical meeting where they're just going to, move, pivot a little bit, move a little bit, or they're going to stay as they are, these typically don't matter. But this counters what I just said. You had a huge kind of rate cut or rate cutting cycle, then you had a huge hike. So, the charts, even, with taking this all into consideration, you would have had in COVID a huge sell-off, bang, you could have just followed the trend. So even again, then, huge meeting, huge decisions made, yes, that could have fundamentally changed your view, but the charts that I like to invest in, what we talk about on this channel, would have, confirmed all this for you anyway. So you don't need to worry about it too much, but I thought this was worth putting in. If you want to monitor the FOMC, use FedWatch. So CME FedWatch shows the probability of the rate moves. So what you can look at is what people are actually predicting. So going into this meeting, we had, I believe it was 35% chance of a cut or 35% chance of staying. Like it was very, I can't remember off the top of my head, but it was very kind of mixed for the first time ever. Typically when we go in, a couple of days before, when it was Powell, we knew it was like 90% probability of being this, and it typically was right. But if you do want to monitor stuff because you think it's important, definitely check out CME FedWatch. I put the link there, but I'll also put the link into the description as well. So before any meeting, you can check FedWatch. Typically, it's already priced in. This is a tool to track it. It's not a signal, but if you do want to keep up to date with these things, definitely the best tool to watch or look at. So what actually matters more than the announcement is the direction of the longer term. So it's not that single announcement, it's where the Fed going to 12 to 24 months, because that's, if we're investing and we're traded, that's what we want to be doing. We want to be looking out into the future and not focus on a single meeting, but focus on the broader, longer term outlook. So the 2-year yield chart that we talked about earlier, can give you more of a view, but monthly market structure on any asset can also give you another view as well. So really zooming out, if you're really trying to look at that broad picture of where an asset's going, monthly market structure is a really good tool as well. So by the time it's in the headlines, the move's already happened. We talk about this all the time. When something's in the news, you're late. And I feel it's really interesting because we obviously just come off the back of, and we're in earnings season in the stock market, and things are moving a lot. By the time there's bullish earnings, super bullish earnings, Apple sells off, and vice versa. So it's really hard to react to headlines and news unless you've maybe got a scalping system and you're in and out very quick. But for most people, that is just not realistic. They don't have the time, or they don't want to invest the time to learn the skill, or they don't, want to do that way. And I think that's totally fine. So the verdict. In the moment, it feels massive, but zoom out. Think where we're going, 12 to 24 months in the future. These things are typically priced in before the meeting even happens. FedWatch, remember, the best tool to kind of keep up to date with how everything's moving. Build a strategy around long-term structure. Think long-term. Don't get too zoomed in on what the Fed are doing. Think long-term. Rate cycles happen over years. So they take time. A single FOMC decision doesn't matter. If you do want to keep up to date with all this stuff, I do have a free newsletter. Link to that will be in the description. See you in the next one.